This is Barry Zalma on insurance. I'm an attorney who has retired from the practice of law and now spend my time as an insurance claims consultant or expert witness, an author and producer of these videos. Today I'd like to talk about the contract of personal indemnity. An insurance claims person, when investigating a first-party property claim, must always ascertain that the owner, or a person with some other insurable interest in the property, is the person insured, and that the person insured has an interest in the property. Failure to do so could result in the insurer paying the wrong person, or paying a person with no right to the benefits promised by the policy. Proceeds of a policy upon the interest of an insured are not subject to the claims of others who have an interest in the property, but are not named as insured, or who do not qualify as insureds by definition. For example, consider Mrs. Jones is allowed to live rent-free in a home owned by her children. Mrs. Jones purchases in her name alone a policy of homeowners insurance, insuring her against the risk of loss to the structure and its contents. If a fire destroys the house, Mrs. Jones can recover because her interest in the house is an insurable interest. That means she has an interest in the property that will allow her to recover for the loss of property if it is lost, damaged, or destroyed. Mrs. Jones' children, the owners of the home, also have an insurable interest in the home, but are not insured under Mrs. Jones's policy and may not recover any proceeds from her policy. In California, as in most states, in common parlance we speak of a house as being insured, but strictly speaking, it is not the house, but the interest of the owner or occupant therein that is insured, and whether that interest is founded upon a legal title, an equitable title, a lien, or such other lawful interest therein as will produce a direct and certain pecuniary loss to the insured by its destruction, he has an insurable interest therein. Only a person who is both an insured and who has an insurable interest may obtain indemnity from a policy of first-party property insurance. In the leading case of Russell versus Williams, a 1962 California Supreme Court decision held and stated the rule as follows. It is a principle of long standing that a policy of fire insurance does not insure the property covered thereby, but is a personal contract indemnifying the insured against loss resulting from the destruction of or damage to his interest in that property. Close quote. The property is not insured against destruction. The insured is guaranteed against loss to the extent of his insurable interest, not exceeding the amount stipulated by the policy as the maximum limit it will pay in the event of a loss. When the betterments and improvements installed in the building pass to the owner at the expiration of a lease, in part consideration for the rent, the tenant could not sell them or remove or recover their value. It therefore had a limited insurable interest, the right to use them until the expiration of the lease, while the owner would have a 100% insurable interest in the property. As a contract of personal indemnity, the policy only insures the person named in the policy against certain enumerated risks of loss of property in which that person has an interest. A person who has an interest in the property but is not named as an insured cannot recover under the policy. Similarly, a person named on a policy who has no interest cannot recover. No one can recover indemnity on a first-party property policy unless they have an insurable interest in the property and are named as an insured, or by definition, are an insured of the policy. For example, I could buy a policy insuring me against the risk of loss of your house. I have no interest in your house. I don't even know you. But I could buy that policy, and if your house burned down, the insurer would determine that I had no interest in the house and therefore could not recover anything from my policy. I had wasted my money buying an insurance policy. On the other hand, if I loaned you $100,000 secured by a mortgage on your house, I could separately insure that interest, and if your house burned down, I could collect on the insurance policy up to my insurable interest of $100,000. The contract is personal to me. You couldn't recover a dime from my policy because you are not named as an insured. The California Supreme Court observed in both Garvey v. State Farm, a 1989 decision, and Prudential v. LMI Insurance, a much more recent decision, that a first-party insurance policy only provides coverage for loss or damage sustained directly by the insured, such as life, disability, health, fire, theft, and casualty insurance. On the other hand, a third-party liability policy provides coverage for liability of the insured to a third party, such as a commercial general liability or CGL policy, a director's and officer's liability policy, a business owner's policy, or an errors and omissions policy. In the usual first-party policy, the insurer promises to pay money to the insured upon the happening of an event, the risk of which was insured. In the typical third-party liability policy, the carrier assumes a contractual duty to thoroughly investigate and defend claims or suits and pay judgments the insured becomes legally obligated to pay as damages because of bodily injury or property damage accidentally caused by the insured rather than to the insured. The difference in the nature of the risks insured against under first-party property policies and third-party liability policies is also reflected in the differing causation analyses that must be undertaken to determine coverage under each type of policy. Property insurance is an agreement, a contract in which the insurer agrees to indemnify the insured in the event that the insured property suffers a covered loss. Coverage, in turn, is commonly provided by reference to causation, such as loss caused by, certain enumerated perils, direct risks of physical loss not excluded, or all risks of physical loss not excluded. The term perils in traditional property insurance refers to fortuitous, active, or physical forces such as lightning, wind, and explosion, which brings about a loss. The cause of loss in the context of a property insurance contract is totally different from that in a liability policy. For example, an injury arises out of professional services if there is but-for causation, though not necessarily direct or proximate causation between the injury and the professional services. In Mimic versus DTE Energy Company, a plaintiff must establish 4 elements in order to bring a negligence claim: duty, breach of duty, causation, and damages. This is not required when a claim is being made for damage to property owned by the insured or used by the insured, that is the personal indemnity contract of the first party policy of insurance. This video was adapted from my book, Zelma on Insurance Claims, 2nd edition, volume 1 of 10 volumes, providing a comprehensive group of materials on property and casualty insurance claims. It is available from Amazon.com as both a Kindle book and a paperback, as well as from my website, Zelma.com, by clicking on the link to the insurance claims library. If you found this video to be interesting or of use to you, please refer it to your colleagues. And please subscribe to my YouTube channel, my Rumble channel, and my blog so that you can learn about future blog postings and videos. Thank you again for your attention